All right. Welcome back to another episode of the Real Estate Investing Club. I hope you guys are having a great week wherever you are. As always, it is Friday here on the podcast, so we're bringing that Friday energy to you. It is Friday, the 31st of January. We are already through the first month of the year. It is crazy. Time is flying, but it is a good day for a second reason because we got Neil Bawa with us on the podcast from Grow Capitus. Neil has over 4,400 units under management with 660 million AUM. He is an experienced guy, and he is known as the data master, the mad scientist, because he is all about data. So I'm excited to get into this because you guys know I love data. I actually love it too much because I get stuck in the weeds of data. It's a love-hate relationship, but either way, I'm super excited to jump into this. Neil, thanks for hopping on.
Thanks for bringing me on, Gabe. Nice to be in the club.
Here you go. I told you before we get on here, we always like starting with stories. We like to hear how people got to where they are. So why don't you take us to the beginning of your story in real estate and just tell us how you got here?
Sure. Computer science graduate. Data science is my specialty. Technologists came to the San Francisco Bay Area in 1997, ran a company until 2013. Big fat tech salary. I live in California, was paying 40 to 50% of my income in taxes, realized that real estate was the way to reduce that. Most people start with a fix or flip or a single family rental. I started by building a 27,000 square foot campus from scratch for my company. It was a nightmare, but at the end of it, my taxes had gone down, my income was going up. So by 2008, I had plenty of money in the bank, and I used data science, opened a meetup in 2009. The data science showed that that was the best time to invest in real estate in 100 years. Most people that came to the meetup would laugh at us or throw F-bombs at us. We were considered to be the most stupid meetup in the Bay Area. We were sort of the laughing
You showed
stock
them, right?
of the area. So it was interesting, but every data scientist that would come in, I live in the San Francisco Bay Area, Silicon Valley. So there were a lot of data scientists. The moment the data scientists would come in, within 45 minutes, they would come in and say, "You're right, this is the best time to buy in 100 years." So the meetup became very geeky. All the non-geek people basically thought that we were a bunch of idiots. The geeky people, who were also the richer people because they had, $200, $300, $400,000 a year jobs, started gathering together, and we started as a group to buy single family homes in dozens. So we were basically buying home. The group was buying a home every week, and we were buying them for 30 cents on the dollar. We had identified through data science, we were looking at all 323 markets and ranking them. And so we would post our rankings on the web for everyone that was in the group. It was a very affluent group. I mean, there were people earning $1 million a year that were working for Apple. And so everyone was buying. Nobody had partners. There was no concept of, you have to go to this guy and he'll show you where to do stuff. It was all like, here's how you do it. Here's the list of cities that we think are great. At the top of this list was Madera, California, which had dropped about 71% from peak. And so we were basically paying 71% off. I personally bought about 15 in Madera. We would buy them in cash, and then within 30 days, we would put a tenant in there, and then we would get a loan, and we'd replicate that process. And the group kept growing because more and more people started to hear that there's this nerd called Neil Bawa that has data science about real estate, and he gathers a lot of it. I had a bunch of volunteers helping me as well that were technically strong. And it sort of developed. So by the time I sold my company to a private equity firm in 2013, I already had a massive database of investors. So when I made that sale, you can imagine I had a multi-million-dollar tax, liability. So I jumped straight to multifamily, 200 plus units. And I thought it would take me 7 months, 8 months to raise the money. So I actually got extensions and paid for extensions. And I sent an email out to my group. And I think in 4 hours, we had raised all the money.
That's awesome. Well,
so 10 years without, ever having a pitch. And then all of a sudden, 237 units. And I think those 10 years really built the database.
Yeah. Well, I mean, if you 10 years of understanding the data. And that is, real estate, it is hands-on, which is one of the reasons why I love it. It's a physical thing that you buy, but it is also very data oriented because you're dealing with markets, you're dealing with the economy, you're dealing with rent prices, with cap rates, NOI. All these are just numbers that you can actually pull from public sources and understand where the economy is going. Um, so there, I mean, there's a lot about your story that kind of jumped out to me. One thing specifically, you mentioned 323 markets that you guys were looking at.
Mhm,
There obviously there's more than 323 cities in the United States. What was their
mhm.
criteria to get onto that list?
There's only 323 metros or MSA
Got
areas
it.
in the United States. Typical MSAs will have three, four, five cities. Larger MSAs will have as many as 25 cities. So we look at every MSA in the United States. The list is on Wikipedia. Just go to Wikipedia and type in MSA list in the United States, and you'll see all 323.
Nice. Well, man, you got 4,400 units under management right now, and so I would kick myself if I did not talk to you about your portfolio. But before we get into that, I just love data. I want to talk more about this data side. So, um, 323 markets, MSAs. I always like looking at the data of the market. I feel like that is the most important thing generally. Obviously, if you
Mhm.
get a self storage facility for $0, it's going to be a good deal no matter what. But you
Right.
really do want to be investing in areas that are growing, both population wise and economically. That they're growing. The average wage is growing. Everything is growing about the city. That's what you want. So. Back in the day, you said Madera, California. That was the one. That was the deal city. That was topped your list. Let's fast forward to today. You mentioned 2008. That was the best time, or 2009 was the best time to invest in over 100 years. What do you see in our current market? It's a very unique market, high interest
Sure.
rates. I feel like
Sure.
prices are kind of inflated. What do you see about our market today?
So the first thing that anyone that's in the multifamily or single family rental business should know is that the market has hit its trough. Over the last 2 years, rent growth in the United States has been either zero or negative, slightly negative or slightly positive, depending upon what state you were in. But there was no place that had good rent growth in the United States over the last 2 years. And the reason for that is the supply in 2023 and 2024, incoming supply for apartments, was absolutely gigantic. It was
Mm.
massive because in 2022, anyone could get a loan at a very low number and use, the interest rates were low, so they were using these low numbers to basically justify building. And so we had massive, massive, massive supply. So that supply in most metros in the United States is either ending in this quarter, Q1 2025, or is ending in the next 2 quarters. There's a couple markets where it's ending later, like Phoenix and Austin, but for the most part, supply in the United States is ending. And when I say ending, it doesn't mean we won't build more apartments. I'm saying that one by one, every market in the United States will go from having too much supply to having supply that's less than demand. That's what I mean by ending. It truly doesn't end, right? So you'll have basically a situation where a sub-market's absorption is 2,000 units in a year, and it's now building 1,200 units in a year. Well, when that happens, two things happen. So occupancy goes up and rents go up. So I'm confidently predicting that in the next 12 months, the United States as a whole will see vacancy go down, occupancy go up. We're at about 94.5%. We should easily hit 95% this year. It could be significantly higher. I'm predicting that rent growth in the United States is going to be around 4, maybe 4.25% for the year, which is a very, very, very good number. And there's certain markets that'll be higher than that. Kansas City, I think, will be at the very top of that list. Austin is probably going to be at the very bottom of that list because it still has a huge amount of supply in 2025. So it doesn't get the positive benefit of lower vacancy as much. So bottom line, multifamily is about to have a good year from the perspective of rents. I don't expect it to have a particularly good year from the perspective of prices because interest rates not only are high, but I don't think we're going to get 4 rate cuts anymore. So we've avoided a recession for sure. The economy is strong. We produced 256,000 jobs in December. And this is 2 years after the Fed started cutting. So if anyone is still thinking recession, you haven't studied history. So usually the recession comes 9, 12, 15, 18 months later. And even if you're saying, well, the recession could come in the months, 3 months, 6 months down the line. By now, job growth would have to be 50,000 jobs a year, not 250,000 jobs a year. So we avoided a recession, which is unusual. The Fed usually doesn't manage it great for us. But the consequence of that is we get 2 rate cuts next year or this year instead of 4 rate cuts. So I don't think that the prices of multifamily are going to necessarily recover. They might go up a little bit. I don't think that they're going to go up much. They might stay flat. But I think rent growth is definitely going to be very strong in 2025. And then 2026, if anything, we get stronger rent growth. We're only projecting 326,000 units to come in 2026. That's too low a number. We need closer to 500,000. Just so you understand how high the absorption is in the United States right now, in Q4, we had the greatest single quarter in American history for absorption of multifamily units, right? 155,000 units were delivered. That's a massive number. That's a run rate of 600,000 a year. That's massive. Normally, we'd be screaming and saying, oh my God, we're screwed, right? We absorbed 230,000 units in a single quarter. That's the greatest quarter in American history, Q4, right? Because that's a run rate of almost 1 million units a year. And I don't think that'll happen in Q1 again. But wow, when you have record-breaking supply, and not only do you absorb every single unit, but you are 70,000 units short, which means your vacancy goes down, your occupancy goes up. That is an insane quarter. And it's happening because the economy is still producing 200 to 250,000 jobs, which means that there's household formation. Yes, but those households are not buying single family homes. In fact, if you've noticed anything in the last 12 months, and you look at how many single family homes are sold each month, that number goes down, 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 down every single month, right? There's no crash in the single family market. In fact, prices are about flat, so they're not going up, they're not going down. But the people that could buy in these high interest rates, they've made that leap, right? The people that are remaining just can't qualify for loans anymore. Even people with $90,000 in household income cannot qualify in any of the top 25 metros in the US, with the exception of Detroit, right? So bottom line is you have $90,000 in income, steady jobs, maybe one person's earning 50 grand, one person earning 40 grand. Your chances of qualifying for a home are zero. So your only other option is to go to multifamily. And that's why we just had the greatest quarter in our history. It doesn't seem like it. Like if you go to a multifamily conference and tell them we just had the greatest quarter in our history, most people will look at you and tell you, you're an idiot. No, we still have issues. Delinquencies are rising. Insurance costs are going up. Multifamily prices are not going up. They actually went down last year. All of those things are true. All of those things are true. But we just had the greatest quarter in our history.
Interesting. So do you see vacancies still continue to go down because the supply can't really go up because interest rates are still really high, so builders aren't going to want to add more units to the economy, which means that there's just going to continue to be a shortage in units? Or what do you see for the next 2 to 3 years?
So what I'm about to say is not a prediction, it's a fact, and I'll explain why. So most of the time, when you make predictions, you can be right, you can be wrong, right? But there are certain predictions where you are more accurate than others. And so I have a crystal ball. This is a crystal ball that works pretty much all of the time. I can't get exact data, but it works. And it's called multifamily permits. It takes on average 30 months to build a multifamily property.
Okay.
Sometimes you can build it really, really fast, but it'll still take you 2 years. And most of them actually take more like 3 years. So imagine looking at all of the permits that have been pulled in the last quarter. Remember that greatest quarter of all time? You just simply go to a website, right? There's multiple websites on the web. Ask ChatGPT, it'll give you a link. These websites publish the number of permits that multifamily guys are pulling, right? And if you look at that number of permits, you know what you're going to be delivering 30 months from now. Does that make sense? Yep. Right? Now, if I go look at Q2 or Q3 in 2024, I would know what we'll be delivering at the end of 2026. The same thing applies for 2023. If I go to the last quarter of 2023, I now know what's going to come in the beginning of 2026. This crystal ball actually works, right? Yeah, because these are permits that are being pulled. Nobody pulls permits until they're ready to go vertical because permits cost a lot of money, right? Yeah. So like an apartment complex of 200 units is $1 million to pull permits. So nobody's stupid enough to pull permits, right? Yeah. Unless they're actually building. So these buildings are in construction. You cannot add any more buildings to that You can only add a building at the beginning of 2025. Well, that's going to deliver almost at the end of 2027. So when you say, Gabe, I already know what the delivery is in 2026. Heck yeah, those buildings are almost done. They're being painted right now. There's interiors. There's cabinetry being put on, right? So unless the United States magically figures out a way to build multifamily faster, and over the last 100 years, we've only gotten slower, right? It actually takes us now 12 months more to build multifamily than in the 80s. Why? Regulation.
Mm,
44% of every dollar that goes into construction is regulation.
that's
44 cents,
ridiculous.
right? So we are so good, so phenomenal at adding more regulation that it now costs us 44 cents more to build something compared to what it did, let's say, in the 100 years ago. So bottom line is, the chances that we're actually going to speed up is incredibly low, incredibly low. So I know what is going to get delivered in 2025. I know what's going to get delivered in 2026. I have no idea what's going to happen in 2027. So I just won't predict anything there. But the next 2 years, because you already know what the supply is, the only variable, which is a big one, is the economy. So
Mm,
if the economy crashes in 2025, yeah, we won't get rent growth. But if the economy stays similar to what we've seen in the last 12 months, there's a shortage of units.
yeah. Yeah, that makes a lot of sense. I mean, you know what happens with permits because they're publicly available, and if it takes that long, I did not know it was 44 cents on the dollar for regulation. Essentially, that's like the
If you
development
were to
cost.
remove every single regulation in multifamily, which you shouldn't, that would be a horrible idea. If you were to remove every single regulation, it would only cost us 56 cents on the dollar to build multifamily.
That is insane. That's crazy. Hopefully, the current administration can help a little bit, at least with reducing regulations. I know that's a big thing on their docket, but we'll see where that goes. Let's go back to talking about MSAs. I really am interested in metro statistics because we don't focus in on one metro. We buy nationally. We buy self storage facilities, mobile home parks, RV parks, and those, it's not multifamily, but they are correlated because the more multifamily there is, the better the self storage industry does. So I'm still really interested what you see in good MSAs, the ones that are performing well in terms of the areas that the metrics just really work out. So what are let's just say your top five MSAs, or let's say top three MSAs, but give me top three large MSAs and then top three medium MSAs.
Sure. So I'll caveat by saying self-storage numbers and multifamily numbers are not the same, so do your own research.
Yeah.
To me, the top metro in the United States is not a metro, it's a portion of a metro.
Okay.
Um, so um, it's the northeastern part of Indianapolis. So Indianapolis is
Indy
the
North. It's
Indy.
interesting. I own a
So
storage facility there.
So Indy is so there's a quad of cities there, Fishers,
Carmel.
Carmel,
Yeah.
and then smaller cities around them. Our data points to that area being the fastest growing for both rent growth and home prices in the United States.
Hmm.
There's a lot of different reasons. Indy's just gotten to the point where you can actually start um, constructing. So we've just got it to the point where you can basically start building in Indy because rents were too low, so people couldn't build. We've crossed that threshold, so there's going to be a lot of people that will start building newer product in Fishers. But overall, Indianapolis is seeing a boom in its population growth, and it's not a very fast-growing city. If you look at the last 10 years, there's nothing impressive about Indy. But if you look at the last 2 or 3 years, it's quite impressive. And then if you look at where those people are going to, they're not evenly distributed around Indy. So this quadrant of Indy is basically about 80 to 90% of all incoming people that are going to Indianapolis. Indianapolis benefits from everything that the Trump administration is doing. I mean, you got to look at the Trump administration. Even if they achieve 20% of what they're saying they will do, there's certain metros that will benefit, and Indy is at the very top of the list. The second one is Reno. So
Hmm.
I think to understand why Reno is such a powerful metro, I'll just say something and I'll wait for it to click in. Reno is the cheapest Nevadan city in California. It's the cheapest Nevadan
Okay.
city in California. So
Right.
you have an economy, very powerful, 40 million people, fifth largest economy on the planet, and everyone's sick and tired of the red tape in California. But they don't want to give up access to the fifth largest economy on the planet. So the best thing to do for companies is to open a small location, not maybe the biggest location in Reno. Now you're, 20, 30 miles from the border, and you're serving the fifth largest economy on the planet, but you're not dealing with the ridiculous red tape that California seems to pile on an ongoing basis. So the Reno is basically a Californian city, but it has property taxes for Nevada. It has sales taxes for Nevada. It has state taxes for Nevada. It has, much less red tape, much less legislation,
And it's only
but
two
it has
hours
access.
from San Francisco. Yeah.
Correct. 2.5 hours from San Francisco. It's perfect. It's only about an hour and a half from Sacramento, the state capital of California. So I mean, it takes me 4 times as long to drive from Los Angeles to Sacramento as it does from Reno to Sacramento. So that's a very powerful city. I think we are going to see tremendous growth there as more and more Californians get fed up and say, how do I get access to Californian markets without Californian legislation? I think the best answer, the only answer, if you really think about it, is Reno, because there's nothing else around that we can look at. Maybe Las Vegas, but Las Vegas has its own challenges.
Yeah. That's interesting because, you're episode 500 something something on this podcast. And every single episode, I always ask, what is your favorite metro? Where are you excited about investing in? And not one of those people have ever said Reno. It's never, nobody's ever said Reno, and you're the first person. But that's
Well,
why
that's
you're the
because
mad scientist, because you get the data.
I think a lot of people think, okay, Reno equals gambling, right?
Yeah.
So why didn't he say Tahoe? Well, Tahoe is a ski resort. I'm talking about creation of money. Here's another reason. I'll give you a reason. And the moment I say it, it'll click in. So the richest people in the San Francisco Bay Area are venture capitalists. Their number one sport and how they mingle with each other is skiing. So
Hmm.
all of these venture capitalists on Friday,
Really?
they
That's
leave
interesting.
at noon and they go to Tahoe where they have very fancy $10 million homes, right? But they don't want to pay California taxes, but they want to live here because, like it or not, we are still the ground zero for the tech economy and the AI economy, right? That
And
happens right here in the
California,
San Francisco Bay Area, right?
for all its negatives, California is beautiful. Like as a
Yeah, it's
state,
it's
it's
incredible, right? So
gorgeous.
they want
Yeah.
to have access to their California home, and so they go to ski in Tahoe, and then they open a venture office. Look at how many venture capital offices are opening in Reno. These are all they started with tax reasons, but then the VC started learning there's a lot of actual other benefits. So all of these offices are growing. They're not just in Reno, they're also in Carson City, which is sort of a, next city over. So Reno and Carson City have started attracting a lot of VC offices, and now there's a startup scene that's there because the VC offices are there. So that's created a new startup scene. Now, so cities that have, these reputations of, oh, it's a gambling city, there's a bunch of casinos. What happens is people don't pay any attention to them, right? I'm paying attention to trends.
Yeah. Yeah. No, that makes a lot of sense. You've convinced me. And it makes a lot of sense being its proximity to the state capital of California. You're right. I mean, everything that you said kind of yeah, just makes sense. It's logical. And that's the litmus test for any good idea is that it's pretty common sense once you lay it out there. All right. So you said Indy, you said Reno. Is there anything in Texas? That's usually where people say is Texas or Florida. There's
Okay,
no
well,
metros in there that you have super excited about.
I was excited about Texas 4 to 5 years ago. The
Hmm.
increase in property taxes and insurance
Oh
has
man, tell me
made
about it.
Texas in the bottom 25% of our list, along with Florida. They're
Oh
in the
wow.
bottom 25% of our list. Now, I want to point this out to you. If you have a lot of money and you use less leverage and you're buying for yourself and you're willing to invest for a 10-year period, I think Texas is wonderful. Dallas would be at the top of my list. Austin may, would be next. Both San Antonio and Houston are also good. So I think all four metros in Texas are wonderful for long-term, low leverage investment. Um, but my investors want to invest for 3 to 5 years, and I can
Hmm.
tell you unquestionably there is no doubt in my mind, zero doubt in my mind, that this is not the time to invest in Texas. Their property taxes and insurance means that the net operating income for properties has been hit extremely hard. Cap rates are not, adjusting enough, and maybe they will adjust over 5 years, and I'll be proven wrong. But for the moment, the mathematics of Texas are poor. As I said, 10 years, go for it. 5 years, be careful.
Yeah. Yeah, I own two facilities in Dallas, and both of those the property tax bill literally doubled from the what 2 years ago, 3 years ago, something like that. It's ridiculous. It's like I called them. I tried to argue it down, and they just wouldn't take it. I guess it's just happening everywhere. But man, that frustrated me. All right. So I really appreciate that. Love the numbers. I love your enthusiasm about this, by the way. Anybody who gets excited about, the data is my friend too. I do have to push us into the quick question round though. Are you ready?
Ready?
All right. Starts with education, can be any form, could be a conference you've gone to, mentorship program you've been a part of, movie you've seen, book you've read, anything like that. But just give me two recommendations, one for general life wisdom and then one for real estate.
My favorite conference for multifamily is the Best Ever Conference. It's in
Mm,
Salt Lake City every year. I go to a whole bunch of conferences, but the quality of the people that I meet at the Best Ever is the best.
yeah.
I always get in trouble for saying that with my friends. And my favorite book is The Miracle Morning. It may
Mm,
not be your favorite book, probably won't be, but it will be the pathway to your favorite book. If you follow The Miracle Morning, you will have time to find your favorite book.
there you go. Miracle Morning. Who is that? Hal Elron. Is it the right one or
Hal
who?
Elrod, yes.
Elron. Yeah, yeah. Okay.
Yeah.
I've been recommended that book multiple times. I actually bought it. It's on my shelf. I haven't read it yet, but I'm going to take this opportunity as a notice that I should get on board with that book. All right, next question is for your younger self. Let's go back to the you who is still working in tech, still getting started. Maybe he was just starting that meetup that he started so many years ago. Go back to that version of Neil, look him in the eye, give him one piece of advice moving forward.
Buy all the Bitcoin you can buy.
You and me both, man. You and me both. I remember having a conversation with my dad. It was like 2008 or something like that, and I was just telling him like, we should put money into this. We should buy some. It's gonna go places. We never did. I kick myself every day. And then also, me and my cousin, we started mining, not Bitcoin. We mined Ethereum for a while, and it's back in the day when you mined, it's in on your, I can't remember. My cousin's the technical one. He was the one who was doing it all. But it got stuck in the account because we lost the password. We still haven't been able to access it. Anyways, that would be good advice for a younger self is buy Bitcoin. All right,
Yep.
next question. We've already gone over this. The metro that you're most excited about investing. Let's look at Indy and Reno. Between the two, which is your favorite?
It's actually Fishers, Indiana, which is a city in Indy. That is my favorite.
All right,
Fishers.
perfect. All right, next question is about getting in contact with the seller and finding that deal. It all starts with penning that purchase agreement and talking with the seller. So, what's your favorite way to generate leads and find new deals?
I think I haven't found anything that works better than text messaging. And the key though is try 8 or 9 different kinds of text messages. I like having ChatGPT write them and then I like editing them. So it does a very good job of starting your thought process, but if you
Yeah,
let it write it's not going to come out well.
yeah,
So I ask it for 10 different examples. I pick 3 or 4 and I send them out. What's interesting is if I had to rank which ones I thought were best, I'm almost always wrong. So it's best to just send out a whole bunch of them.
yeah. It is funny how that works. I always feel like I will write out like for mailers that I do, I'll write out this like elaborate mailer, and then the one that actually gets calls is the one that's like just dumb simple. It's just like, hey, I saw you own this, give me a call.
Yep.
And it's funny how that kind of works out. So text message it's a great way to reach out to sellers. Do you have a specific platform that you like that you can recommend people use?
I'd recommend one for making phone calls because you text messages will not prevent you from making phone calls. We love using Phone Burner and we use it exactly the way that they have designed it, and it increases our phone velocity by 2x. Anyone can use it. It's $150 a month for one license. Boy, you're going to save a lot of time with Phone Burner.
Perfect. All right. Next question is about lessons learned. Not every deal that we get into goes the way we expect it. In fact, most deals have some kind of problem, but that is when we get to learn our best lessons. So, what was the deal that went a little sideways for you? And then what was the lesson you pulled from it?
Deal in Chicago, I basically bought it because the Obama Presidential Library was being built next to it, and there was a very, very large 5,000 unit development on the U.S.
Thousand
Steel
unit. Jesus
factory,
Christ.
right?
Okay.
U.S. factory a mile down south. Both deals got into legal trouble, still haven't been built. The Obama Presidential Library still hasn't started construction. What I learned is, yes, look at these factors, but always look at the deal on its own merits, right? So when I'm looking at Fishers, Indiana, I'm very excited about all the factors, but I'm still doing the math on Fishers, and if the math on the Fishers is not good, then I no longer look at it. It will be a lovely market that I won't invest in.
Yeah. Yeah. If you, if the property has 100,000 in NOI and they're asking 100 million, doesn't matter what metro you're in, that's not a good deal.
Yep.
So always go back to your underwriting. I like that. All right, that leads us to the very last question. You have given us a lot to think about. I'm sure people want to reach out to you. This is a two-parter. Where can they find you, and then what can they expect when they reach out?
The best way to find me is either to search for my name. I'm the only Neil Bawa on the World Wide Web. But a better way to do it is to go to a website called multifamilyu.com. That's multifamilyU.com or Multifamily University. About 14,000 people sign up for our webinars. Last year, we had 14,000 people sign up. We do webinars one a month. They're interesting, fun, and data-driven. We're doing one called Real Estate Trends, which is coming up in the next week or so. And then we do them on all other topics in real estate: Airbnb, single family, multifamily, industrial, self-storage, you name it. And then we do trends like, what is the impact of Trump? What's the impact of climate change? What's the impact of AI? So that's where we distribute our data. We do not have an educational platform that is paid, so you'll never be upsold. Out of 84,000 people that have attended our webinars, 1,200 are investors. Everybody else, 98.5%, have just been getting free education for a decade.
Perfect.
Multifamilyu.com.
Multifamilyu.com. I will put that in the show notes. So if you guys want to check that out, all you got to do is just click the little more in the description. That'll pull down that full description, and in there you can find that link. It's pretty easy to remember, though. You just type it in there, multifamilyu.com. All right, Neil, that wraps it up. Thank you very much for hopping on the show.
Thanks for having me on. Bye-bye.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe at the realestateinvestingclub.com. If you want to support the show, just leave us a review. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.